Hello and warm welcome to Global Markets in Focus. My name is Gregory Perdon and I serve as Co-Chief Investment Officer at Arbuthnot Latham in London. Now, my objective today is to take you on a tour around the world to talk to you about the mega trends which are impacting global markets. And we will start, of course, as always, on what is top of mind. So, the IMF has come out and warned that we are entering into the largest economic contraction since the Great Depression. What's their forecast? -5% this year, which indeed will be very challenging to overcome. But the good news is we have coordinated efforts from governments around the world in the form of fiscal fireworks. What's the number? Close to $11 trillion worth of announced deals, which indeed is going to be very powerful. Now, some are coming out and warning caution over the fact that government debt to GDP ratios are going to soar, which indeed they are. I'm a little bit more, in inverted commas, relaxed about the matter in light of the fact that many of the countries which are issuing these government bonds control their own currency, and of course interest rates remain low and will probably continue to remain low for the foreseeable future. So what are we watching? All eyes on the US election as Trump begins his proxy technology war with China and begins saber-rattling again with Europe on tariffs. This on the backdrop of a potential second wave of corona infections. And of course, the reversals from what we're seeing in some of the state governors in terms of some of the openings are making for a challenging environment. Let's head to the continent for a second. A little bit of good news, some warming of the waters between the ECB, the European Central Bank, and the German High Court in relation to the legality of some of the quantitative easing bond buying programs, which indeed is good news and will help to peel away some of the uncertainty in relation to the prospect for continued quantitative easing infinity in Europe. Also, we had some positive economic data which beat expectation in terms of some of the PMIs in France and in Germany, which indeed is welcome. And finally, we had some good news out of Spain as the Spanish government has decided to continue to support many of the employees that are currently on leave all the way to the month of September. Coming closer to home in the UK, we also saw some good economic data. We saw a surprise flash PMI services number register at 47, better than expected. Still in contraction territory, but 40 was the whisper number, so that indeed is very good. We are indeed seeing a little bit of bounce back to normal from the business environment. And on the topic of bouncing back, the Bounce Back Loan Program, which is 100% guaranteed by the UK government, has seen some good take-up. 921,000 small companies have put in applications to borrow £28 billion worth of capital. Now, there is some criticism of the plan. Some analysts are coming out and arguing that much of that capital won't be paid back. I am a little bit more sanguine about the matter in light of the fact that I would prefer that scenario than for the UK economy to be hit with a wall of unemployment, which would be good to avoid for obvious reasons. Let's finish off in Asia. We'll talk about Japan for a second. The Bank of Japan, they continue with their monetary magic. They continue to jawbone and communicate to the market that they're prepared to do whatever it takes, whether it's reshaping the yield curve, whether it's asset purchase programs, whether it's new lending schemes. One of the most aggressive central banks. And I doubt they're doing a great job communicating, but I doubt they're going to be writing any haikus anytime soon about their failed inflation targets. But be that it may, they've done a great job so far at communicating their intentions and at easing financial conditions. So good job on them. And finally, in China, it looks like it's going to be the year of the dragon as opposed to the year of the rat, as it's projected that China may be one of the only nations this year to generate a positive GDP print. IMF has come out and announced that they expect China to grow at between 1 and 1.2% on the year, which indeed would be a stellar return in light of the challenging circumstances. This on the back of increase in corporate profits by approximately 6% over the course of the past 12 months. With that, I'll say thank you very much, and I'll see you next time.